that kind of like, the market's just all over the place.
Yeah.
It's hard to know, what to really focus on.
Yeah.
So we're going to try to bring some clarity to that today.
Right.
With a deep dive into Howard Marks' latest memo.
Okay.
He's, the co-founder of Oaktree Capital.
Yep.
And he's made a pretty big call on this one.
He has.
He thinks that right now credit is looking like a much more compelling investment than stocks.
Interesting.
So we're going to dig into why he thinks that's the case.
Sounds good.
Right off the bat, he comes out and says that the current economic environment,
Right.
this is like one of the most uncertain he's seen in his entire career.
Wow.
And, you got to think this is a guy who's been in the markets for decades.
Exactly.
So for him to say that.
Yeah, that's a huge statement.
It is.
And I think, we've seen some of those indicators.
Yeah.
With the tariffs and the recent stock sell-offs.
I mean, that feeling of uncertainty,
Yeah.
it really shifts the way you have to look at different investments.
Absolutely.
And Marx points out there's been a pretty rapid change
Okay.
in high-yield bond yields.
Yeah.
So that's the interest rate that's offered on bonds
Right.
from companies that have, maybe a little bit lower credit rating,
Your risks.
a little bit more risky. Yeah.
Yeah.
And those yields have jumped
Okay.
from around 7.2% to
Yeah.
8% in just 6 weeks.
Wow. So that's a significant jump
Yeah, it's pretty quick.
in a short period of time.
Yeah.
And so while that's been happening at the same time, we've seen, the stock market kind of dropping over 15% in the same period. And we've also seen volatility kind of go up as well.
Yeah. Yeah.
So his core argument here is basically the potential returns on credit are starting to look a lot more attractive
Right.
relative to the risk that we're seeing in equities right now.
Yeah. I like the analogy he uses to kind of describe this whole situation. He says it's like the world economy is being shaken up like a snow globe.
Right.
And I think everyone can relate to that.
I know I can, yeah.
Like that, you're just kind of waiting to see where everything settles.
Totally, yeah. You don't know what it's going to look like when the snow settles.
Exactly.
Yeah.
And, one of the big things that he points to as contributing to this shaking
Right.
is this move away from globalization.
Right.
He is a huge proponent of free trade.
Yeah.
And he uses this very simple example
Okay.
to kind of illustrate
I
it.
like his simple examples.
Yeah.
He does a good job with that.
He talks about pasta and watches.
Okay.
Imagine if Italy had to make all of its own watches
Right.
and Switzerland had to make all of its own pasta.
Right.
You lose all of that efficiency.
You'd have some pretty bad pasta probably in Switzerland.
Yeah. And probably some pretty expensive watches coming out of Italy.
Yeah, exactly.
And everyone is just worse off because of it.
Yeah. Nobody wins.
And so his concern is that these tariffs,
Yeah.
which are essentially taxes on imported goods, that this could undo one of the big benefits of globalization,
Yeah.
which has been, keeping inflation under control.
Interesting.
He actually notes that U.S. durable goods prices fell by 40% over 25 years,
Wow.
thanks to global trade.
That's significant.
Yeah. And so, this kind of leads him to the question then of
Yep.
what kind of returns can we really expect from the stock market? Historically, it's been around 10% annually,
Yeah.
but that includes periods when valuations were much lower
Okay.
than they are today.
Right.
Right now, the price to earnings ratio,
Right. The PE.
the PE, yeah,
Yeah.
which is essentially, how much investors are paying for each dollar
Right. A measure of valuation.
of a company's earnings.
Yeah.
It's around 19,
Okay.
which is above the long-term average of 16.
It's a little bit higher than average.
Yeah. And he points out that historically, when you've bought stocks, when the PE ratio is at 19, you've typically only seen annual returns of 2 to 6%.
Interesting.
So, he's sort of suggesting that those double-digit returns that we got used to,
Yeah.
maybe those aren't going to be so easy to come by going forward.
Right. Potentially lower returns going forward.
Yeah.
Okay.
And so then he contrasts that with credit.
Okay.
And he says, with credit, there's a different kind of clarity. When you invest in bonds,
Yeah.
you've got a much clearer promise of what you're going to get.
Yeah, you know what you're going to get in terms of your interest payments and when you get your principal back.
Exactly. And, Marx has a really strong track record in credit.
He does, yeah.
He's been doing this for a long time.
Yeah, he points out his 47 years in high-yield credit.
Right.
And he says that about 99% of the companies that issue those bonds have paid as promised.
That's a pretty high success rate.
It is, yeah. I mean, obviously nothing's guaranteed in the markets.
Right. But that's about as close as you're going to get to a sure thing.
And so I love this analogy he uses.
Okay.
He compares the current market to a Bloomingdale's sale.
Okay.
It's not a reason to panic and sell everything.
Right.
But it is a time to be really discerning.
Yeah, look for some deals. Look for some value.
Look for the bargains.
Yeah.
But at the same time, he's not trying to sugarcoat things.
Right.
He's very clear about how difficult it is to really value assets right now.
With all this uncertainty.
With so much uncertainty.
Yeah, it makes it really difficult.
You've got, these rapid changes happening. You've got these unreliable forecasts.
Things changing so quickly.
Yeah. And he even says, and I think this is a very striking statement, he says, we know less about the future today than at any point I can remember.
Wow.
And that really, I think, kind of, sums it up.
That's a sobering thought for sure, coming from somebody like him.
Yeah. And he also raises a really important red flag about U.S. spending.
Right.
He refers to it as like we're using a gold credit card.
Interesting.
And we've got these huge deficits.
Yeah.
And his concern is that, if global investors start to lose confidence in U.S. debt, that there could be some pretty significant consequences.
Makes sense.
Yeah.
So, bringing it all together, despite all this uncertainty, despite all these challenges, his overall view is that credit with these increased yields and the clearer return profile is looking like a much more attractive investment than stocks right now.
So given everything we've discussed about all the uncertainty and the potential changes, what adjustments are you thinking about making in your own portfolio?
Yeah, how are you thinking about, kind of balancing risk and potential returns?
It's a tough question, but it's one that we all have to grapple with right now.
Absolutely.
Yeah.
So thanks for joining us for this deep dive.
Yeah, it was fun.
Always a pleasure.
All right.